In this video, I'll explain to you how four major Singapore REITs are performing as they prepare to report their distributions in October. You'll learn about their recent financial results, strategies for growth, and what to expect in the coming months. This information is crucial for any investor looking to build a strong, income-generating portfolio in the Singapore REITs market. Let's dive in and uncover the potential these REITs hold for your investment strategy. Hey there, fellow investors. Iggy here from the Investing Iguana. As we approach the end of the year, it's time to take a close look at some of the biggest players in Singapore's REITs market. Today, we're going to dive deep into four blue-chip REITs that are set to announce their distribution payouts this October. This is exciting stuff, folks, because these announcements can give us valuable insights into the health of the real estate market and potential investment opportunities. Before we jump in, let me remind you that the Investing Iguana has been recognized as one of the top financial content creators in Singapore. We're ranked 8th in the 2023 Influential Tigers by Tiger Brokers, with over 800,000 reads. Our channel has produced more than 500 videos with over 250,000 watch hours as of September 2024. So, you can trust that you're getting solid, well-researched information here. Let's start with Frasers Centrepoint Trust, or FCT. This retail-focused REITs has a portfolio of 9 suburban malls and 1 office property across Singapore. Some of their star properties include Causeway Point, North Point City North Wing, and Waterway Point. FCT's recent performance has been a mixed bag. In the first half of their 2024 fiscal year, they saw a 7.2% year-on-year decline in gross revenue to 172.2 million Singapore dollars, and an 8.4% drop in net property income to 124.6 million Singapore dollars. Now, before you get worried, there's more to this story. These declines were primarily due to the divestment of Changi City Point and ongoing enhancement works at Tampines 1 Mall. When we factor out these one-off events, FCT's underlying gross revenue and net property income actually grew by 2.9% and 2.1% respectively. One of FCT's strongest points is its incredibly high occupancy rate, standing at a remarkable 99.9% as of March 31, 2024. This is a clear indicator of the trust's ability to attract and retain tenants, even in challenging economic conditions. They've also achieved positive rental reversions of 7.5% for the first half of 2024, up from 4.3% a year ago. This means they're able to renew leases at higher rates, which bodes well for future income growth. On the financial front, FCT is maintaining a healthy balance sheet with an aggregate leverage ratio of 38.5%. This gives them some breathing room and flexibility for future investments or to weather any economic storms. However, it's worth noting that their distribution per unit for the first half of 2024 did slip by 1.8% year-on-year to 0.06022 Singapore dollars. This is something we'll want to keep an eye on when they announce their full-year results on October 25, 2024. Moving on to our second REITs, Mapletree Industrial Trust, or MIT. Unlike FCT, MIT focuses on industrial properties in Singapore and data centers in North America and Japan. As of June 30, 2024, they have a diverse portfolio of 140 properties across these regions. MIT has been showing some positive growth recently. In the first quarter of their 2025 fiscal year, they reported a 2.7% year-on-year increase in gross revenue to 175.3 million Singapore dollars. Their net property income also grew by 1.3% to 132.5 million Singapore dollars. This growth was largely driven by contributions from a newly acquired data center in Japan, as well as new leases and renewals across their existing properties. One of MIT's strengths is its solid portfolio occupancy rate, which stood at 91.9% for the first quarter of 2025. They've also managed to achieve an impressive weighted average rental reversion rate of 9.2% for their Singapore properties. This suggests that demand for their properties remains strong, even in the face of economic uncertainties. MIT's financial management also looks solid. Their aggregate leverage stood at 39.1% as of June 30, 2024, which is well within comfortable limits. They've also done a good job of spreading out their debt maturities, with no more than 25% of borrowings due for refinancing in any financial year. Additionally, about 82% of their borrowings are hedged at fixed interest rates, providing a buffer against potential interest rate hikes. For the first half of 2024, MIT declared a distribution per unit of 0.0343 Singapore dollars, up 1.2% year-on-year. This increase was driven by higher net property income and increased distributions from joint ventures. MIT is scheduled to announce its second quarter results for fiscal 2025 after the market closes on October 29, 2024, so mark your calendars for that important update. Our third REITs is Mapletree Logistics Trust, or MLT. This trust specializes in logistics properties across key Asian markets. As of June 30, 2024, MLT's portfolio includes 188 properties across 8 countries in Asia, with a total asset value of 13.4 billion Singapore dollars. That's a massive portfolio, folks, and it gives MLT significant exposure to the growing e-commerce and logistics sectors across Asia. MLT's recent performance has faced some headwinds. In the first quarter of their 2025 fiscal year, they experienced slight dips in both gross revenue and net property income, down 0.3% and 0.9% year-on-year to 181.7 million Singapore dollars and 156.7 million Singapore dollars, respectively. These declines were primarily attributed to weaker performance from their assets in China, the absence of contributions from divested properties, and currency depreciation of the Japanese yen and Chinese yuan against the Singapore dollar. Despite these challenges, MLT has maintained a stable portfolio occupancy rate of 95.7% as of June 30, 2024. They've also achieved a positive rental reversion of 2.6% from leases renewed during the quarter, which is a good sign for future income growth. MLT's capital management remains strong. As of June 30, 2024, their aggregate leverage stood at 39.6%, which is well within acceptable limits. They've done a good job of spreading out their debt maturities, with no more than 21% of their borrowings due in any single financial year. Furthermore, 83% of MLT's total debt is either hedged or secured at fixed rates, which helps protect them from rising interest rates. However, investors should note that MLT's distribution per unit for the first quarter of 2025 dropped 8.9% year-on-year to 0.02068 Singapore dollars. This decrease was due to lower divestment gains, rising borrowing costs, and a larger unit base. It will be interesting to see how they address this in their upcoming results announcement on October 22, 2024. Last but not least, we have Mapletree Pan-Asia Commercial Trust, or Impact. This REIT has a diversified portfolio of retail and office properties across key gateway cities in Asia. Following the divestment of Mapletree Anson on July 31, 2024, Impact's portfolio now comprises 17 commercial properties across Singapore, Hong Kong, China, Japan, and South Korea. Impact's recent performance has been relatively stable. For the first quarter of their 2025 fiscal year, they reported gross revenue of 236.7 million Singapore dollars and net property income of 179.4 million Singapore dollars. While they benefited from stronger contributions from their Singapore assets, these gains were offset by the depreciation of the Japanese yen and Chinese yuan against the Singapore dollar. As of June 30, 2024, Impact's portfolio occupancy stood firm at 94%, with a weighted average lease expiry of 2.5 years. This suggests a stable tenant base and consistent income stream for the near future. On the financial front, Impact maintained an aggregate leverage ratio of 40.5% as of June 30, 2024. They've done a good job of spreading out their debt maturities, with no more than 19% of their total borrowings requiring refinancing in any given financial year. Additionally, 78.9% of their loans are hedged at fixed interest rates, providing stability in the current high interest rate environment. However, like some of the other REITs we've discussed, Impact's distribution per unit for the first quarter of 2025 declined by 4.1% year-on-year to 0.0209 Singapore dollars. This decrease was primarily due to higher finance costs in the current elevated interest rate environment. Investors will want to pay close attention to Impact's second quarter results, which are set to be released after market hours on October 24, 2024. Now, let's take a step back and look at the bigger picture. These four REITs represent different sectors of the real estate market: retail, industrial, logistics, and commercial. Their performance gives us valuable insights into the overall health of Singapore's real estate sector and the broader economy. One common thread we're seeing is the impact of higher interest rates on these REITs' performance. Most of them are facing increased borrowing costs, which is putting pressure on their distributable income. However, it's encouraging to see that they're all maintaining healthy occupancy rates and achieving positive rental reversions. This suggests that demand for quality real estate remains strong, despite economic headwinds. Another factor to watch is the impact of currency fluctuations, particularly for REITs with significant overseas exposure. The strengthening of the Singapore dollar against other Asian currencies has been a drag on the performance of some of these REITs. This highlights the importance of geographic diversification in managing currency risks. As we look ahead to the October announcements, there are a few key things investors should keep an eye on. First, watch for any changes in distribution per unit. While some of these REITs have seen slight declines in their DPU, it will be important to see if this trend continues or if they can reverse it. Second, pay attention to occupancy rates and rental reversions. These are key indicators of a REIT's ability to maintain and grow its income. Strong performance in these areas can offset some of the pressure from higher interest rates. Finally, look at how these REITs are managing their debt. With interest rates likely to remain elevated for some time, REITs that have a higher proportion of fixed-rate debt and well-spread-out debt maturities may be better positioned to weather the current economic environment. In conclusion, while these REITs are facing some challenges, they all seem to be navigating the current economic landscape relatively well. Their focus on high-quality assets and strategic locations, combined with prudent financial management, should help them maintain their position as blue-chip investments in the Singapore REITs market. If you found this video helpful in understanding the current state of Singapore's REITs market, please hit that like button and subscribe to the Investing Iguana channel. Your support helps us continue to bring you in-depth analysis of the Singapore stock market and beyond. And if you're hungry for more REITs content, you're going to love our video on SGX Dividend Kings, 8.56% yields uncovered. In that video, we dive deep into some of the highest yielding stocks on the Singapore Exchange, including some REITs that offer incredible dividend yields. It's a perfect follow-up to this video if you're looking to build a high-yield portfolio. You can find the link to that video in the description below or in the end screen. Thanks for watching, and I'll see you in the next video. Remember, in the world of investing, knowledge is power, so keep learning and stay informed.